How much are your investments costing you? Investors and a lot of the investment offers out there like to talk about past returns, but that's not a great indicator of future returns, and on average, by definition, you're just as likely to underperform the market as you are to beat it. But it gets worse, because of fees, which take that hopefully at least average return and start dragging it down and potentially costing you hundreds of thousands by the time you retire. Dean Kendall joins us today to discuss all the fees you might be getting nailed with and how to deal with them. Dean is a financial organizer and the author of the aptly titled book, Stop Paying Hidden Investment Fees. Welcome to the MapleMoney Show, the podcast that helps Canadians improve their personal finances to create lasting financial freedom. Our sponsor, Borrowell, recently launched their mobile app, which makes checking your financial health even easier. The app includes Molly, Canada's first AI-powered credit coach, who will make it easy to understand your credit score and give you tips and product recommendations. To sign up, go to MapleMoney.com/Borrowell today. That's MapleMoney.com/BORROWELL. Now let's talk to Dean. Hi, Dean. Welcome to the Maple Money Show.
Yes. Hi, Tom. Great to see you.
So I came across your book first. Normally we mention it at the end, but can you kind of just tell me what your book is quick, just because it'll set up this show nicely?
Sure. Yeah. The book that I've written is called Stop Paying Hidden Investment Fees. And the subtitle is How to Get Unbiased Advice for the Right Fee so that you can reach your financial goals years earlier.
Great.
Yep.
Okay. So let's start with the negative side of this. There's a lot of fees that people sort of maybe aren't so hidden. People realize these fees exist, and then we can also get into truly the ones they don't even realize they're paying. First of all, maybe we can start with where I think most of the fees probably are is with mutual funds. Can you kind of go into some of the different sort of fees and expenses we're paying there?
Sure. So with mutual funds, there's various ways they can be purchased, and that triggers different fees. So some common terms that you hear are front-end load or a front-end fee, and that's where a certain percentage comes off of the original investment. So essentially, you have less money working for you up front. So that's one. Another one is a low-load fee, and it charges a certain percentage if you redeem your assets within a set window of time. So usually a 2 to 3 year period, depending on the firm. So if you let your money ride for 3 years, you don't necessarily pay a redemption penalty. But if you had to pull money out in year one, there's an additional cost to do that. The other one that's you hear is called back-end load or deferred sales charge. And that one is the same as low load. The difference being it usually runs for a 6 to 7 year period, again, depending on the institution. And you're just penalized a bigger percentage if you pull your money out within that first 6 to 7 years. So those are kind of the sales charges, we call them. And then, of course, there's that MER, the management expense ratio that you always hear about. And that's really the cost of running the investment. And some, to make it confusing, some are all in, meaning you pay a set fee, like let's say 2.5%, and that might include what the compensation is to the advisor. They may receive a trailer fee within that 2.5% of, let's say, 1%. And then the other 1.5% is really the management expense ratio to get to the 2.5% in this example. So that's a commission type account.
Yeah, I've had years ago, I had mutual funds that were sort of 2% plus. And back then I thought I was being pretty smart. I was starting to learn about personal finance. I had a job as a financial analyst. I thought I knew this stuff. So I was building this portfolio. But by the time I had so many different mutual funds, I was really just creating an index anyways, and but paying like 2.5% on this. So I definitely get the pain of a management expense ratio.
Yeah, absolutely. Yeah, the other one we sometimes isn't as discussed as much as the TER, the trading expense ratio. So that can be an additional cost over and above the MER. And that's how often the money manager is buying and selling and trading. So sometimes that can be another 1/4%, that sometimes people don't realize either. So yeah, it's another thing to look out for.
So is this sort of that active versus passive deal there? Like, is that what you mean there? That's the active trading?
Exactly right. Yeah. So the money manager basically taking on I call it the myth of believing that they can time the market or provide, better research, and therefore they're buying and selling and moving, shifting the assets around on a regular basis to try to enhance the rate of return. But as a result, there's higher fees for that. And I guess that's another argument in the industry, passive versus active. Yeah, that's a big one.
Yeah. Well, let's go into that a bit then. Sort of, what are the pros and cons of both, or at least what people say they are? Maybe you're on one side, but how's that battle kind of play out?
Yeah, well, at the most basic level, active is really higher. A mutual fund is a great example of active money management, where there's a manager that is in charge of doing homework and research on various stocks or bonds or whatever's in the portfolio to try to basically outperform the index is their goal. They're trying to add value, and that's really the premise, beat the market. The other side is passive, and passive is really matching the market. So you're really just buying the market. You're not trying to outperform. And as a result, there is no money manager per se doing the active piece and the buying and the selling. So therefore, the costs actually drop down considerably. So yeah.
So with ETFs, I'm a big fan of these now. What are the expenses around that?
Yeah, the expenses are quite low. Like, an example in Canada anyway, like, so let's say Vanguard, just to pick a company, their fees could be 0.1% to 0.25%, so a fraction of 1% just for the MER component. And then usually there is no TER because they're not actively trading, the trading expense ratio. So cost is way, way, way less than a typical traditional mutual fund, let's say, that's actively managed.
Yeah, and I've always liked the idea that thanks to that low cost and the fact that they are the average, that you're likely to beat a lot of these active mutual funds. So it's not just about fees, it's how those fees let you be average, which is fine. It's not a bad thing in this case.
Right. Exactly right. Yeah.
So we've covered mutual funds and ETFs. The other one I can think of right now is stocks. If someone wants to invest on their own and they want to go to one of the stockbrokers, what kind of fees are they looking at there?
Well, I guess there's the full service stockbrokers, and some of them might charge, for a trade. It's kind of a negotiable thing, but some might charge $150 a trade. Some might charge a flat fee for the trade. Other institutions might be a little bit more aggressive, and maybe it's $50 or $75 a trade. So it's kind of a variable thing. There's really no fixed. There's maybe a fixed number on the ceiling, the maximum, but it can go lower. Some advisors might even say, "We'll cover your trading costs."
Oh, okay.
So it can be quite an array of options there.
What about the low costs? I know things like Questrade. What is it, $4.95 or something like that, right?
Right. Yeah, exactly. That's another option for sure. I guess you might call them the do-it-yourselfer investor, and by all means, they can go down that path. And I'm not sure, like TD Waterhouse or TD Direct, they might be $9.99, and to your point, $4.99. But that's per trade, so it's drastically reduced. So I guess the only differential there is advice versus no advice. So whatever that's worth, to the individual. But for the do-it-yourselfer, that's a great way to go.
Yeah, and I've seen it come up before. If people see the deals of, well, on ETFs we don't even have commissions. I don't think that's totally true, because I believe there's some fees in there still. Well, first of all, when you sell on a lot of the services, they still take their commission there. But I think there's even some kind of little trading fee that they do get dinged for, even when they're buying.
Mm-hmm.
Yeah. Now you mentioned financial advice. This is sort of the other side of it, where there can be I assume more fees as well. First of all, where do you stand on this? Is your company all fee only, or is there a commission to this?
Yeah, we charge a flat fee for the service that we provide. So it's a fixed dollar amount for a set, checkpoints and or we call it deliverables that we provide. So we tell our clients exactly what they would receive on the onset and exactly what it would cost depending on their situation.
Okay. Can we go into a bit of sort of the issues with any of these commission based advisors? Sort of things like bias for sure would be one of my first concerns.
Yes. Yeah. So I guess with certain advisors, some are commission based, so they receive a commission. Basically, they have to sell a product in order to get paid. So there's a inherent problem in that where maybe they're pushing a certain product that may pay them more. You have to wonder about the fiduciary standard with that. So commission is one method. Another one is fee-based. And a fee-based investment methodology is really just a percentage of assets. So it's quite similar to the commission one, but again, it comes back to a percentage of the investable assets. So both models charge, again, a percentage of the portfolio, let's say. Mm-hmm. So the other thing that people have to be careful of is, are they just providing money management for that fee, or are there other services, other financial planning services potentially in that cost that they're charging based on a percentage of assets?
So do you mean if they're looking at two services and it's starting to look like it's going to be the same price, do you mean sort of going in and seeing the difference between the two, like what they're actually getting for that dollar?
Yeah, I think that's critical that they need to understand on the way in, because how the industry is structured, there might be one advisor who might charge, let's just say 1% of assets, and all they provide is money management. And there may be another advisor who could, charge that same 1% of assets, but maybe they provide some other services. So it's just critical to understand what you're actually getting, because the industry doesn't have set rules on what the deliverables are, what actually has to be provided for that 1% of assets, as in this example.
Yeah, I don't mean to keep complaining about my mutual fund experience with banks, but I thought that was a financial advisor at the time too. Was and now I compare it more to like a car salesman. they're there to sell you a product, and they're not really there to do much else.
That's right. I would agree. I would say the vast majority of financial advisors, unfortunately, planners, advisors, because they're paid a percentage of assets, and because the only way they're ever compensated is to sell a product, essentially they're salespeople. Mm-hmm. That's in the most simplistic terms. That's what a salesperson does. No disrespect, but if they don't sell a product, there's no compensation, and that's essentially how the majority of these institutions operate.
Yeah, and in a way, there's nothing wrong with someone being a salesperson, but
right.
Maybe it's in the branding, right? Like we go into stores all the time. We're used to this, but maybe there does need to be some kind of rules there that you're not a financial advisor, you're a financial sales associate or something like that.
Yes. Yeah, that's right. You're bang on, because within the industry, I think the current rule book is still anyone can call themselves a financial planner. No regulations around that. So what happens is they have that on their name tag, and if everybody takes them at face value, they think they're getting proper advice, and that's probably the biggest issue with the industry, right? Mm-hmm. And CARP, the Canadian Association of Retired Persons, and a lot of other organizations are lobbying for the regulators and the legislators to get with the program and start protecting consumers more. So I think it's a real issue.
Yeah. Are there any other fees that we should be looking out for? Anything I didn't cover either on the investments themselves or the services people sort of hire?
Those are the big ones, the management expense ratios, the trading expense ratios, and then also, of course, the component that's paid for advice by the advisor. One of the other points of clarity or fuzziness in the marketplace is CRM2 came up recently, and some of the fees are basically disclosed on an annual compensation report or statement, but the distinction there is those are only the fees that are paid to the dealer. Those are not the investment management fees. So now some people feel that they have full disclosure, but again, it's only a fraction of the total fee they're paying. Mm-hmm. So there's still confusion in the marketplace, as to what am I paying in total to the advisor, for the MER, for, all of this is a total. What is that as a number or a percentage? It still seems quite fuzzy, unfortunately.
Well, what are the current rules with that? And as a follow-up to that, sort of what would you like to see, like a certain breakdown, or how do you think that should change?
Yeah, well, I think CRM2, it's a step forward, but it's still definitely suspect, because again, it provides disclosure on the cost of advice only. So the cost of advice is really just what goes to the dealer. That isn't even a breakdown of what the advisor receives, because every dealer has a different payout or percentage that goes to the advisor. So that's advice, the advice component only, but then they do not put down anything regarding the cost of the investment product on that annual compensation report. So yeah, that's a problem. It's not full disclosure. So I guess what I would like to see is on your annual statement have a total of everything, what's going to the advisor and what the products themselves cost as well, so that someone can see in one line, this is the all-in percentage or dollar amount. But right now it's still only fractional. Like that example, if the average equity portfolio is 2.5% in Canada and the advisor is getting 1%, the other 1.5% is still in cyberspace. It's not being shown. And the other problem is they say there's a new sheet called Fund Facts that under IROC and MFDA, the advisor is supposed to show that fund fact sheet at the time of purchase. But what I found is when I ask clients or people that have been referred to us, have you received one of these for every investment that you have? And the answer is a lot of times no. So meaning because it's not mandatory, advisors are choosing not to produce that. So that's a real problem.
Yeah, as you're saying that, I kind of pictured with credit cards, the rule is like on your statement you get, well, if you pay the minimum balance, it's going to take you this many years to pay off. It would be great if they'd say, well, if you keep going at these fees, you're losing this much by your retirement. Something like that would probably get people to change their ways pretty quick.
Exactly. Yeah, that's crazy.
Let's go into that a bit. I don't mean to put you on the spot with this, but do you have any examples, even rough examples of how much this can add up to? Say your retirement's decades away, is sort of what is the cost of this? Because when we talk about 1% here, 2% there, it doesn't sound like a big deal. But I know this can add up quite a bit if you're 30 and sort of saving for retirement way in the future.
Yeah, that's exactly right. Like in the book, actually, I go into excruciating detail with a lot of those examples where you're exactly right. It's only 0.5%, which is 0.5, but you add this up, like even on $100,000, 0.5%, it doesn't seem like 0.5 as a percentage isn't a big number. But when you take it on 100,000 or 500,000 or 1 million, and then you start adding up what that is every single calendar year, and then when you do a future value on that over the investment lifetime, that somebody has 30 years, 40 years, 50 years, it becomes hundreds of thousands of dollars. In some situations, obviously millions. It's just massive, but it's just these little incremental numbers that people can't really see or feel. And therefore, unfortunately, they don't see the real end damage of that. And it's much better to keep that money in your pocket than, again, funneling it into these institutions that aren't, in my mind, disclosing properly.
Mm-hmm. It sounds kind of similar to the benefits of compounding interest over time, except in reverse. It's sort of you're losing more and more every year.
That's right. Yeah, it's massive, and like I say, it's just small little decisions, but it ends up being hundreds of thousands. These little decisions are really major decisions, and that's why I think they're not being tracked or found out as quickly.
Mm-hmm. So if someone's listening to this show and they start looking at their statements and they're seeing what they're paying on mutual funds and what they might be paying an advisor and everything, and they want to turn this around, what can they do? Like in my case, going back to my mutual fund story, I kind of got lucky. It was late 2008. So I was selling before things really started to drop. But because I was doing the home buyers plan, I should say. And so that's what got me out of them. I just happened to clear most of them out for the home buyers plan. And then when I repurchased, I started doing it through ETFs. But if someone wants to say like, okay, I need to change this, what do they do? Where can they start with this? I assume would they sell what they have, or would they just continue with it in a new direction?
Yeah, that's a great question. I think the starting point is, anyway, this is one thing that we do. It's called a truth and fees exercise. And what it is first is it's really understanding what you are paying. I think that's a starting point. Basically, is it fair? Is it reasonable? Am I paying a premium relative to the marketplace? So it's first, what am I paying? And then understanding what the alternatives are, and what that spread or differential is. Because if it's a big enough spread or differential, then that's the first trigger to, hey, I should reallocate or be doing something different. So I think that's the first piece. The other part is, just understanding certain fees can be, let's say, tax advantaged depending on how they're set up. That's another important thing, just way you structure your investments. The other thing is passive versus active investing. So as we talked initially, you can save a massive amount of money by following a passive investment management strategy versus active, which is what I would suggest. I really say active managing or active management is a myth. And there's lots of details in the book, third-party details that talk about other individuals who don't have a horse in the race who have actually tested this out, active versus passive. And the evidence is overwhelming that passive beats active on longer periods of time, bar none. Actually, a gentleman, Eugene Fama, is one individual who talked about that and put that evidence together for consumers. So that's a good piece to look at.
Mm-hmm. For me, it was the little book of Common Sense Investing. Really sold me on the idea of passive investing. I can't remember what his numbers were, but it was certainly huge. It was probably like 3/4 or whatever. It was where passive would beat active, especially because of the fees, but also just because of people hopping in and out at the wrong time and everything.
Yeah, exactly. Yeah, that's another part. Yeah, if they're trying that timing the market thing just doesn't seem to work. But unfortunately, for whatever reason, advisors and or people sometimes, attempt to do it. And unfortunately, like you say, it doesn't always work out.
Yeah, I'm a little bit guilty. It's mostly good, but one thing I try to do is I try, and I'm still sticking with ETFs most of the time, but I do try to buy on the down points. Like it's still timing the market by all means, but it's just trying to get a bit of a sale.
No, that's prudent. Yeah, absolutely.
Yeah, but I've never sold really, so I I can't say what I would do in that case. But I totally get the idea that you can't truly time the market. I just try to, if I have a little extra money, to at least buy on when there's all these things out about an index being down. Like, oh, okay, I'll get a little more.
Right. Yeah, because I guess one of the things that you always hear, with active managers, every year it's something different. There's some reason why you need to be active, right? Trump's in the White House, Korea is this, Iraq is that. There's always some news story as to why, but every time those news stories come out and, the numbers are crunched, it's the same verdict. So I think that the active management is really just a big sales tool, because all these institutions, that's how they make their money. They don't have a vested interest to push passive. They're not going to hear that.
Yeah, and I get why people buy into this. It feels like someone's at the wheel kind of thing. Why would you just want an index or a robo advisor or something like that to handle all this when they can have someone doing this full time? So I see why people think this is a good idea, but you're right. The results just aren't there.
Yes, absolutely. Yeah, that's a great point.
This has been a great talk of just how to get through reducing all these expenses and everything. Can you let people know where they can find you?
Yeah, they can find me. So I'm in Calgary, Alberta. My phone number is 403-543-7226. My website is www.ideal-life-experience.ca. So those are probably the easiest ways. My email is dean@ideal-life-experience.ca.
Great. Thanks for being on the show.
Thank you, Tom. It was great speaking with you.
Thanks, Dean, for running through the various investment fees and how we can avoid them. You can find the show notes for this episode at MapleMoney.com/Dean Kendall, or head over and check out all the episodes at MapleMoney.com/show. Last week I said I'd read out another iTunes review that wasn't quite so glowing. However, I don't see it in iTunes, so maybe it was removed. I appreciate that, but it was a legit critique. While I don't have it available to read, basically it said that the show was good, but I have a nervous laugh that makes me seem less confident, and that's a distraction. Now, it's not a lack of confidence, but a bit of a habit that I do often, not just on the show, but in real life. I can't say I can stop it, but we'll try to reduce it a bit as I'm always looking to improve. Thank you for listening each week. If you can take a moment to leave an iTunes review, I might read yours next. I don't plan to do it every episode, but if your review catches my attention, I'll give it a shout out on the show. And I'll see you next week when Joe Salsihai joins us to talk about the financial water cooler talk that we engage in online and how we can make the most of it.